All right, so back on chapter 9. Next, we look at accounting expenses. And so, for the most part, um, business owners are able to select their overall method of accounting for tax purposes as well as specific accounting methods such as um, LIFO versus FIFO versus weighted average. So the overall accounting method would be either cash, accrual, or some hybrid method where you incorporate uh, cash for some parts of your business and accrual for other parts. Specific, again, LIFO, FIFO, weighted average as it relates to inventory. Now, having said that, the IRS does treat certain things differently than you would if, for instance, you were reporting under an accrual method of accounting. Okay? So, general rule is you get to adopt your overall accounting method and specific accounting methods, but because financial accounting reporting purposes are different than the IRS's reporting requirements, there is some variation where the IRS requires you to report a certain way, so you don't get a choice. So think about the objective of financial accounting. Uh, the objective of GAAP, if you're using the accrual method, is to recognize income as quickly as possible, but not expenses as quickly as possible. So accelerate income and while at the same time avoiding an expense or at least putting it off as long as possible. That way net income is maximized. Well, with taxes, taxpayers have a motive or an incentive that's different than financial accounting reporting purposes. Um, Whereas for financial accounting purposes, you want to accelerate income. For tax purposes, taxpayers want to stall recognition of income as much as possible. When it relates to expenses, you want to, for financial accounting purposes, you want to put off expenses as long as possible, whereas taxpayers are motivated for tax purposes to accelerate expenses. Well, the IRS knows that, and so that's why they have specific rules concerning how specific types of income and expenses are treated. All right, so as far as overall methods, again, you have the cash method. You get to recognize income when it's received rather than when it's earned. As far as expenses are concerned, you recognize an expense when it's paid, not when it's accrued. Accrual method. Recognize income when earned or received, whichever is first. As far as expenses, whenever you accrue it, that's when it's recognized. And then, like I say, you may be able to use what's called the hybrid method. And so certain items are accrual and certain items are cash. And so if it's accrual, you use the accrual method. If it's cash, use the cash method. How do you adopt your overall method? Well, you simply file your first tax return. And once you do, you got to keep using that method unless you get the permission from the IRS to change your overall method. Now, as it indicates here, large corporations, for many reasons, have to use the accrual method for both financial accounting purposes as well as tax purposes. All right, so briefly talk about the methods. Again, when it's actually or constructively received is when you recognize the income. Expenses recognized when paid. So it's just like we as individuals do with our checkbook. When we receive money, that's when we recognize it. When we pay an expense, that's when we recognize that as well. But as you can imagine, it doesn't really match income and expenses that well as the accrual method, but it's very simple, and for small businesses it works quite well. So for that reason, it is allowable. And so notice you have a dollar amount. If your average annual gross receipts are $25 million or less over the 3 prior tax years, you can use the cash method. That's usually not a problem. The accrual method. You have to recognize income when you meet what's called the all events test for income. And so the all events test is a two-pronged approach, although that second prong, no, the first prong is three-dimensional. All right, so you recognize income under the all events test for income when, number one, you when all events have occurred that determine the right to receive the income, and the amount of the income can be determined with reasonable accuracy. Gee, that sounds a lot like for financial accounting purposes, and appropriately so. And assuming that the amount of the income can be determined with reasonable accuracy, it really comes down to the all events test. And so the all events test is met when the earliest of the following occurs. When the taxpayer completes the task required to earn the income, or when payment for the task is due from the customer, or when the business receives payment for the task. Makes sense. The one down at the bottom, payment is received, seems obvious. But it creates some additional things that you might not have considered here that we'll talk about. All right, so question here, Ben provides consulting services and bills Ace for $12,000. Ace disputes the amount, claiming that $8,000 is the appropriate amount. How much income should Ben recognize under the accrual method this year? Well, at this point, he's provided the service, so the all events test has been met. But that second prong, the amount of income that can be determined with reasonable accuracy, is in dispute. Well, even though Ace disputes the $12,000 amount, they do agree that they owe at least $8,000. So at this point, Ben can recognize $8,000. What about prepaid income? Well, under financial accounting, when you make a prepayment, when you receive a prepayment for goods or services, under financial accounting, you defer recognizing income. For tax purposes, when you receive a prepayment, it depends on the type of income it is. If you're receiving interest or rental income, you must recognize the unearned rental and or interest income immediately upon receipt. Now, what if you receive a security deposit from a rental customer? Well, unless it's not going to be paid back, you can defer that security deposit as income. Well, okay. What if you, the taxpayer, pay for goods and services in advance? Well, for financial reporting purposes, you would not immediately recognize um, trying to look here. Well, and again, why do you have to recognize income for advance payments? Well, remember that um, under the all events test, you have to recognize income for tax purposes when one of those three requirements are met. And so in this case, the third requirement, when payments received, has been met. Okay? So that's why you have to recognize income on prepayments. Now there is an exception to immediate recognition. And so you're allowed to defer recognition for 1 year unless the income is earned or recognized for financial records. Now again, this exception does not apply to payments related to rent or interest income. All right, so we have an example here. Ben provides dancing lessons. On September 30th of this year, he received $2,400 full payment for a 2-year service contract. What amount of income must he recognize? If he's on the cash method, if he's on the accrual method. So for the cash method, he's got to use $2,400 as recognition. If he uses the accrual method, then he can elect to defer certain advances for a year. And so he would recognize in this year, again, the scenario is he received it September 30th of this year. He would recognize 300, so it's basically for 2 years at $100 per month. And so here we're dealing with 3 months worth. So he would recognize 300 of the 2,400. Note here that he's got to recognize it in that next year, even though some of this is actually earned in the year after that. So that's kind of the exception to the exception. You've got to earn it all, the remaining portion of the prepayment, in that next tax year. All right, moving on to accrual deductions. So page 21. For expenses. So when you under the accrual method, you incur a liability by creating a liability account. And debiting an expense account. So it's immediate upon incurring the liability. For tax purposes, totally different. Again, you've got an all events test involved here. And so for claiming a tax deduction for an expense, it must meet both the all events test and something called the economic performance test. The all events test for deductions. And so for that, it says for a business to recognize a deduction, the events that establish the liability giving rise to the deduction must have occurred, and the amount of the liability must be determinable with reasonable accuracy. Pretty simple. Notice here, reserves for future liabilities are not allowed. Well, what does that mean? Well, recall that for financial accounting purposes, you have to determine the amount of bad debt write-offs every year, even though you're not going to write them off until sometime in the future. Well, guess what? You don't get to do that with tax expenses. And so you'll see here at the very end of the chapter, they talk about bad debt expenses. You're basically on a direct write-off method for tax purposes. All right, what does it mean for economic performance to occur? So it says that an accrual method business is not allowed to deduct a prepaid expense even if it qualifies to do so under the 12-month rule that we talked about, unless it has met the economic performance test with respect to the liability associated with the expense. And so the specific requirements for the economic performance test differ based upon whether the liability has arisen from either receiving goods or services from another person, use of property, providing goods or services to another person, or certain activities creating payment liabilities. And so, and again, this only applies to accrual method taxpayers. When a taxpayer provides goods or services to another party, performance occurs as the taxpayer provides the goods or services. Taxpayer using property or goods. The performance occurs as the goods are provided or economic performance is otherwise expected within 3.5 months of payment. Moving to payment liabilities. For payment liabilities, economic performance occurs when these liabilities are actually paid. And so, and there's a category there, or different categories there under Exhibit 9-2. And so for these particular categories, economic performance occurs when the taxpayer pays the liabilities associated with these different categories. Workers' compensation, tort, breach of contract, or a violation of law. Rebates and refunds, awards, prizes, and jackpots. Insurance warranties and service contracts provided to the business. Taxes, and then the big catch-all, other liabilities not provided for elsewhere. And so if it's not provided for elsewhere, you don't get to deduct the expense until it's actually paid. And so in essence, what's happening is you're on, as far as expenses are incurred, you are on a cash method of accounting. When you're renting or leasing property, you meet the economic performance test as the rental occurs. So you recognize it over the rental period, your lease payments, your rental payments. As far as payment liabilities are concerned, is something called the recurring item option or exception. If says that under this exception, accrual method taxpayers can deduct certain accrued expenses even if economic performance has not occurred by year end. A recurring item is a liability that is expected to recur in future years and is either not material in amount or deducting the expense currently matches with revenue. Excuse me. And so also, I encourage you to look at Exhibit 9-2, which gives the categories of payment liabilities, as well as Exhibit 9-3, dealing with different liabilities that you can incur and when those particular liabilities economic performance occurs. At the bottom of page 24 and top of page 25. Again, for bad debt expenses, if you are an accrual method taxpayer, well, for both financial and, well, for financial purposes, you are going to have a bad debt expense that you accrue every year. When you sold a product or service originally on credit, what did you do? Well, you debited a receivable and credited revenue. And again, when we're talking about for tax purposes, if you elect the overall method as accrual for tax purposes, you do the same thing when you provide a good or service on credit. The key here is under financial accounting, like I said originally, you have to, at the end of the year, determine how much of the receivables at the end of the year might have to be written off because it's uncollectible in that next year. Well, you don't expense it in that next year. You go ahead and expense it at the end of the year so that it affects your net income this year, the current year. For tax purposes, you are only allowed to deduct a bad debt expense when it becomes uncollectible, and in the year it becomes uncollectible. The book says only when the debt actually becomes worthless within the taxable year. Well, when does a debt become worthless? Well, usually if the debtor files bankruptcy and there are no assets to collect from or liquidate for the benefit of the taxpayer. And so while for financial accounting purposes you're using the allowance method for bad debt expense, for tax purposes you are using the direct write-off method for determining bad debt. Well, what if you're a cash basis taxpayer? Can you deduct a bad debt expense at all, anytime? And the answer is no. Well, why is that? Remember, you're on the cash basis of accounting. You never recognized a revenue. So why would you be allowed to deduct a bad debt expense if you never recognized the revenue in the first place? Because you never received the money. So cash basis taxpayers are never allowed to recognize a bad debt expense. Now again, how do you adopt an accounting method? You elect it by doing it on your tax return. And so at this point, question is, well, if I want to change methods, how do I do it? Well, it depends on whether or not the method you are currently using is a permissible method or an impermissible method. Furthermore, when a business technically adopts a method depends on whether or not it's a permissible accounting method or impermissible method. So again, for permissible accounting methods, you adopt by using and reporting the tax results for at least 1 year. For impermissible accounting methods, whether intentional or not, the business adopts that impermissible method by using it for 2 consecutive years, regardless of whether or not it's a permissible accounting period or method or impermissible. Once you adopt it, you must get IRS's permission to change. If it's a permissible change and you want to choose a different method that's permissible, you've got to have a good reason why you're changing. Well, what about if it's an impermissible method? Well, if it's an impermissible method, you still have to get, again, you've got to use it for two or more tax years for it to be adopted. So if it's less than 2 years, you could just make the change without getting the IRS's approval. But if it's 2 or more years, for IRS purposes, you have adopted it. Therefore, you must get the IRS's approval. So you are basically self-reporting your nonconformity. Why does the IRS require you to get permission once you've adopted an impermissible tax method or accounting method? Well, they want to know about it, and they want to make sure that the method you're changing to is going to be permissible and appropriate. Well, why would a taxpayer self-report an impermissible use of an accounting method? Well, if you know that you're going to get caught eventually, it's best to just come clean early on. If you do, the IRS is going to show you a lot more leniency than if you wait until they catch it. And by leniency, I mean they're going to charge. They're probably, if you self-report, there's a good chance, and you're not a multiple violator, meaning multiple times violating their rules. They may even, certainly it's going to reduce the amount of your penalties and interest, but they may even waive the penalties or the penalties, not necessarily the interest though. They don't do that very often. All right, so that's it for chapter 9.